Most people follow financial advice their entire lives and still end up broke. Not because they lacked discipline, not because they weren't smart enough, but because the advice they were given was never actually built for them. It was built for someone else. Someone who clocks in at 9, clocks out at 5, and collects a paycheck every 2 weeks. The moment someone steps outside that structure, the rules stop working. And most people never figure out why. Here is the truth nobody in the financial industry wants to say out loud: the mainstream financial advice machine runs on one assumption. That assumption is that the person listening has a stable job, a predictable income, and an employer willing to match retirement contributions. Everything built on top of that assumption, from the savings plans to the tax strategies to the investment frameworks, is designed around the employee. Not the entrepreneur, not the investor, not the freelancer or the business owner. The employee, and that gap has quietly cost millions of people their financial futures. The financial system was built around the paycheck. The entire modern financial system in America was structured around employment. The 401 was introduced in 1978, and it became the cornerstone of retirement advice for decades. Every financial planner, every personal finance book, and every money podcast eventually circles back to it. Max out your 401, take the employer match, contribute consistently. It is solid advice, but it only works if someone has an employer to begin with. Warren Buffett has spoken about this distinction for years. He built his wealth not by participating in employer-sponsored plans, but by owning businesses and acquiring assets that compound over time. His approach has almost nothing in common with the advice given to the average salaried worker. Yet that average worker is handed Buffett quotes and told to invest in index funds and wait 40 years. The principles get borrowed, but the full picture never comes with them. The tax code tells the same story. Employees receive a W-2. Their taxes are calculated, withheld, and filed in a relatively straightforward way. But business owners operate under an entirely different set of rules. They can deduct business expenses, structure their income strategically, use entities like S-corps to reduce self-employment taxes, and leverage depreciation on assets. These tools exist inside the same tax system, but most financial advice never touches them because the audience it assumes has no use for them. When someone like Elon Musk or Jeff Bezos,
different advanced technologies, as I said, SpaceX, Tesla, now you've got Solar City and the Solar Pack that
pays a lower effective tax rate than their secretaries, it is not because of loopholes. It is because the tax code rewards ownership, and most financial advice does not teach ownership. It teaches how to save from a paycheck. Why the advice industry profits from keeping people employed. There is a reason this gap has never been corrected. The financial advice industry profits from people staying in the employee mindset. Banks make money on savings accounts and mortgages. Brokerage firms make money on managed accounts and funds. Insurance companies sell products tied to income replacement. All of these business models work best when a person has stable, predictable, employment-based income. An entrepreneur with volatile cash flow and complex tax needs is harder to serve. More importantly, they are harder to monetize with off-the-shelf products. Robert Kiyosaki, author of Rich Dad, Poor Dad.
This is the cash flow quadrant, book number 2. E is employee, S is small business, self-employed, or a specialist like a...
He argued that the school system and the financial system are both designed to produce good employees, not good asset builders. His critics push back on some of his methods, but his core observation about the employee versus owner divide in financial education is hard to dispute. Schools teach students to earn grades to get jobs to earn salaries. Nobody teaches them how to read a cash flow statement or structure a profitable business entity. The media reinforces this pattern. Most personal finance content is built around saving tips, debt payoff strategies, and retirement account optimization. These are genuinely useful topics for employees, but they represent only one lane on a much wider financial road. They get criticized by traditional financial commentators. But their perspective is not wrong. It is simply aimed at a different type of person, one who earns through ownership rather than labor. The financial advice industry also benefits from simplicity. A message like, save 15% of your income, scales across millions of people. It requires no customization. It requires no knowledge of someone's business structure, tax situation, or investment goals. Simple messages are easy to broadcast, easy to monetize through advertising, and easy to package into books and courses. But the people who actually build wealth at scale do not do so by following simple, universal rules. They operate in complexity, and complexity is not profitable to sell. What financial advice looks like when it is built for owners. The difference becomes clear when looking at how wealthy business owners actually manage their money. They do not just save from income, they structure income itself. They create entities that allow profits to flow in tax-advantaged ways. They use their businesses to generate deductions that offset personal tax liability. They invest in assets like real estate, private equity, or their own companies that produce returns far beyond what a standard index fund offers over the same period. And they think about money not as a percentage of salary to be set aside, but as a system to be designed. Real estate is one of the clearest examples of this divide. The standard financial advice script rarely dedicates serious time to real estate investing beyond the purchase of a primary home. Yet figures like Barbara Corcoran and Grant Cardone built 9-figure net worths primarily through real estate, not stock portfolios. The tax advantages available through real estate, including depreciation, cost segregation, and 1031 exchanges, are powerful wealth-building mechanisms, because the average salaried employee has no practical use for them. Retirement planning for non-employees works differently too. A solo business owner can open a solo 401 or a SEP IRA and contribute far more annually than a traditional employee ever could through a standard employer plan. A business owner with the right setup can shelter significantly more income from taxes each year while still building long-term retirement wealth. These options exist. They are legal, accessible, and widely used by financially sophisticated individuals. But most people never hear about them because the financial content they consume does not assume they have a business to work with. Even the concept of an emergency fund changes depending on the model. Employees are told to save 3 to 6 months of expenses in a liquid account. That is reasonable for someone whose income disappears entirely if they lose a job. But a business owner with multiple income streams, a line of credit tied to business assets, and the ability to scale revenue through decisions has a fundamentally different relationship with financial risk. The same rule, applied blindly, may actually be the wrong strategy. The people who build real wealth do not follow the standard script. Taxes as something to navigate strategically, and assets as the actual destination, rather than retirement accounts being the final stop. Mark Cuban has said in interviews that paying off debt and building cash reserves was his priority before investing, because he understood that opportunity requires liquidity and flexibility, not just a diversified portfolio. The financial advice most people receive is not bad advice. For an employee with a steady income, health benefits, and an employer matching retirement contributions, much of it is actually quite useful. But it is incomplete. And for anyone who earns money outside of traditional employment, it can quietly steer them toward a destination they never intended to reach. The real question is not whether to save or invest. The real question is which version of the financial game someone is actually playing. Because the rules for the employee and the rules for the owner are not the same game. They never were. And the sooner someone understands which table they are sitting at, the sooner they can start playing with the right cards in their hands.